Hello, everyone, and welcome to the new episode Behind the Wealth. We are very lucky today. We have Michael Blake, the head of Centuria Life, to enlighten us with his knowledge about the particular product that I would like to talk today. But before we start, I would like to say this, the standard thing with compliance, that everything we say today, it is general advice and it's not a private advice. And if you have any questions, please call your accountant or contact your financial planner. Or of course, alternatively, you can call us in our office at Silver & Young Private Wealth. So welcome, Michael, and thank you very much for accepting our invitation.
Thanks for having me.
I guess a lot of people just search for the perfect investment, the double-digit, return investment. And what they're forgetting is where they're going to put this investment in what vehicle. And correct me if I'm wrong, I think the investment bonds, for example, it is the forgotten child of the investment vehicles family. What's your thoughts about that?
Yeah, that's right. The returns you get will be a result of the underlying assets that you invest in. But then you've got different ways to invest in those different assets, be it shares or property or fixed interest. And in investment bonds, you're investing in a vehicle where the fund pays 30% tax on behalf of the investor. Now, if you're on the highest marginal tax rate of 47%, that's quite a saving. Now, you can also invest in superannuation, where you get taxed at 15%, which is a fabulous investment. But of course, you can't access your superannuation until you retire. So an investment bond is a nice investment structure that sits in the middle between investing personally and investing in superannuation.
And the alternative to the investment bond to the superannuation, or the alternative of the superannuation to investment bond. I had this question with a client that said to me, okay, the superannuation tax is 15%, and this vehicle that you are talking about taxes 30%. Why should I go to this vehicle, to investment bond, and I don't go invest to the superannuation?
That's correct. Superannuation is a fabulous investment, as I said, and you should try to get as much money in there as you can. However, you can't put all your money in there. For instance, when you make superannuation contributions out of your salary, there's a cap at which you can contribute each year. And also there's a cap at which you can put in non-superannuation money as well. So for instance, if you were to downsize your house, or if you were to make a windfall profit, or you might win the lotto, you just can't put $1 million into your superannuation tomorrow. So that's one of the restrictions with superannuation, is the amount you can put into it, both on a contributions and a maximum amount, whereas in investment bonds, you can put in any amount you like. And the other thing is accessibility. The government really doesn't want you touching your superannuation until you hit retirement age of 60 or 65, whereas investment bond, you can access your money at any time. And that's why we call our product life goals, because you might want to save for when you're 30 or when you're 40 or when you're 50, because along the way through life, we have other goals other than retirement. You might be saving for a home, or you might be saving for a holiday, or you might be saving for your children's education. And that's where an investment bond gives you that advantage over superannuation.
The other question I'll probably ask, and I'm jumping now here backwards and forwards, forgive me for that, it just flow the interaction with my clients. The other thing is, okay, I like what you say, all right, I'm a high income earner, and I can't put more than $25,000 this year and $27,500 next year as a concession contribution. So I get your point. If I want to put more to something, I get this pay 30% instead of 47 if I'm on a top marginal rate. Okay, what is the accessibility of this money? Can I take the money anytime I want? And what has the effect of taking the money or leaving the money for more than 10 years?
Yeah, so people with these investment bonds, you do get extra tax benefits after 10 years, but your money is accessible at any time. So when you invest your money into the investment bond, the fund pays tax on your behalf at 30%. So you don't have to pay a tax return. You don't have to do a tax return on those earnings, which is really simple for you. You just sit back and put the money in there. The fund pays tax for you. Now, if in the first 10 years you pull your money out, you get a tax offset of 30%. Okay, because the fund has already paid 30% tax. So let's say you're on 47% tax, you'll get an offset of 30% on the earnings, which means you only have to pay tax on that 17% extra component. So you're no worse off than if you'd invested the money yourself and pay tax at 47%. However, if you leave the money 10 years, then you can pull your money out 10 years to 30 years if you want to, and you can pull your money out after that, and you don't have to pay that additional top-up tax. So that's one of the big benefits of these investment bonds, is that after that 10-year period, there's no additional tax to pay. But within the 10 years, you can get your money whenever you like. You just have to pay that differential between your tax rate and the 30%. Now, if you're going to retirement, for example, and your tax rate might be 15 or 20%, getting that 30% of tax offset can reduce your tax that you may have received from a rental property or some shares or other investments you might have. So as long as you're paying tax, you're still going to do pretty well with that offset.
Yeah. And the other question I really had is the vehicles that we invest inside the investment bonds. Say, for example, can I put ETFs? Can I invest in other more complicated structures? Can I do, say, for example, property? I mean, it's a silly question. We can't do property, but just what is the comparatives to the super or to other investments? What is, through the insurance bond, can I buy individual shares, or I buy a fund manager who manages the portfolio?
Yeah, there's a tax ruling with these funds where the investor can't pick and choose individual shares, because what you're actually investing into is a benefit fund. And that individual benefit fund is signed off by auditors and actuaries every year to ensure that money doesn't get into other investments. So you can't pick individual shares, and you can't buy your investment property up the coast. But what you can invest in is a range of different managed funds. So in our product, we've got 31 different investment options to choose from. So you can invest into cash funds, fixed interest funds, property funds, share funds, both Australian and international, balance funds, and more aggressive growth funds. And we've got a range of managers in there. So your clients may have heard of Magellan or Bennelong or MLC or some of these big name fund managers. We've got a range of those investment options in here to choose from, and you can pick them and switch between them whenever you like. And what we do at our investment committee is we try to make sure that we've got the best funds available on that menu for you to choose from.
Beautiful. And the way I understand it, so for example, if I invest, say, I'm 45. I mean, I'm a bit old. I look older than 45, but suppose I'm 45, and then at 55, I want to get access to my investment bond. I can really create a tax-effective income pre-retirement. I mean, I've seen one of your presentations that about create a tax-effective income stream, and I really like the idea that if, for example, I'm a high income earner and I put a lot of money on the side on this, I topped up my super and I have excess cash available to invest it. Then if I invested and I'm this early retirement age, say before 55, but I started an investment bond, say for 45 years when I was 45. Then after 10 years, really, I want to explore to this situation that can I get my investment bond as an income stream over a period of time till I really retire, to supplement that if I worked part-time or if I ease down or if I have tax-free income?
Yes, you can. It's an interesting fact that you can't get your superannuation until you turn 60. But if you Google retirement ages, you find the average Australian retires at around 56. So we've got a bit of a gap there on income streams. So we get a lot of younger investors. They might be people that are saying, well, you know, at 50, I might want to retire, or I might want to go into a consulting role, or I might want to spend more time traveling. So being unable to access your superannuation till you're 60 means you need to build up another nest egg to draw income down on. So as you said, you might be 40, you start a savings plan and you can contribute monthly. So you contribute every month out of your salary, out of your bank account. And then when you hit 50 and you say, I want to unwind a bit now and I want to get some income stream, it's just reversing that direct debit from your bank account to a direct credit, and the money will go back into your bank account. And you can choose the amounts that you want to draw down from that each month. Obviously, the more you draw down, the less time it lasts. But as you draw down that money, none of that is taxable for you. So you don't have to put that income stream into your tax returns. So it's a nice way to build up a pre-retirement income strategy. And then, as I said, leave your superannuation for later on. The longer you can go before accessing your superannuation, the better, because don't forget, it's accumulating returns and only paying tax at 15%. So leaving your super as long as possible is a good strategy, and that's where the investment bond can fill that gap.
Absolutely. I like this scenario a lot. But the other thing I really like on the investment bonds is the estate planning. So can you elaborate a little bit about estate planning? Because I remember when I started as an accountant and financial planner 25 years or so, 30, I had very few families that they were split, it become as a blended family to me. But in the last 5 or 10 years, there is a lot more blended families and more complicated blended families. Not just simple, I divorce and I married again and I start again. No, complicated. She has children, I have children, a lot more interacted. And especially for wealthy clients or even not that wealthy clients, still, I think the insurance bond it's an important instrument on the estate planning. Can you elaborate on that?
Yes, it is a good tool for estate planning. One of the things about these investments is when you make the investment, you can nominate a beneficiary. And if you were to pass away, the money goes directly to that beneficiary and there's no tax payable. So it's like the 10-year rule has come in to the date of the passing away. And we pay the money directly to that individual. Now, if you pass away and there's your normal assets, such as your money in the bank, shares, your property, that'll go to your estate and there's a probate process. And what can happen under the probate process is people can challenge the will. And we see this happen quite a bit, particularly in what we call complicated families. And if we think about it, we all know a complicated family. And what happens in that situation is that people in the family may challenge the will. And under the Family Provisions Act, the judge can overturn your will and can pay the money out as the judge sees fit. So you might have an example where you've got one child who you haven't seen for many years. You may not have seen them for 20 years, and you might leave them out of the will, and that person will find out you've passed away. They can take it to court. They can challenge it. They can say, hey, I'm a child of that person, the same as the other family member. And in about 85% of the cases, the judge will overturn these cases when there's family members challenging the will. So it becomes very, very important where you've got complicated families where you've had divorces and multiple children, and maybe it's the grandchildren wanting to leave money as well in the will. And we quite often see cases where the grandparents might want to leave money to the grandchildren, in which case their direct children may challenge that. So the idea of an investment bond and being able to nominate this beneficiary means that on the event of passing of the life insured, we pay the money directly to that person within 10 days. It doesn't go through the will, it doesn't go through probate, and therefore it can't be challenged in court. So it's a very clean and simple way to leave amounts of cash that you may want to leave to people that have been good to you over your life, I guess.
And it is also very important for asset protection as per se. I mean, if you are in a high litigation environment like accountant, lawyers, builders, it is good to put some of these probably savings tucked away in an instrument like insurance bond, because as I understand, it is really tucked away and you can explain better how it works.
Yeah, we call that creditor protection. And because it's a life insurance policy, so I have an investment bond and I have 3 daughters, and if I was to pass away tomorrow, they would each receive a third of that money in that investment bond. Now, hopefully I live for a long time and it'll accumulate to be a large amount of money. But if I had a business where I was prone to litigation, I might be in the construction industry or something like that, and something went wrong in my business, and the creditors came after my company, then because that money is a life insurance policy and they're beneficiaries, it's not part of my assets, and therefore it gives you that creditor protection. So it's a nice way to put money away to I guess give you protection. If you're in an industry where there may be litigation, and a lot of small businesses where you have loans, etc., you may find yourself, maybe due to reasons beyond your control, such as COVID, where your revenue starts to fall away. The bank calls in the loan, they go after your personal assets. With this investment bond money, they can't go after that money.
The other thing that I think this product used a lot is from grandparents. Is correct? They want to bypass. I had this question actually. The client said, "Look, my son is a lovely son, but he's hopeless with money. and he is really on the brink of divorce. So I don't want to leave him $50,000 and get divorced in 3 years' time, 2 times. I hope to survive the marriage, but he's bad in money and he's really prone to divorce. And I want to leave this money to my kids. So this insurance to my grandchildren, this insurance bond scenario, it could fit that need of that particular situation. Is that correct?
Yeah, that's correct. What happens, we have a facility called a child plan. And under the child plan, you can nominate the age at which the beneficiary receives the money. So typically you'll get grandma and granddad. They want to leave some money to each of their grandchildren. So they'll take out one of these child plans. So they might put $10,000 into one of these child plans. They nominate the child. Now, if the child's 2 years old, it's not much good if they get the money, because their parents will be the guardians of that money, and they may choose to go and spend it anyway. But what happens with the child plan is you can nominate what we call a vesting age, and that vesting age is between the age of 16 and 25. So you might say when the grandchild hits 21, I want them to receive this amount of money. Now, if the child's 5 years old, then you've got 15 years to invest the money. So you might choose a more aggressive investment, sort of underlying investment, because you've got a long time period to invest. So, for example, if you're investing in Australian shares for a 15-year period, you could double or even triple the balance that you put in there. And then even if you pass away, the money is held by us until that child hits that vesting age, and then we pay it out to the child. And that way it skips that generation. It goes directly through to the grandchildren. The other thing to think about is with those children who are bad with money, let's say, what will happen if your will is challenged under family provisions? What tends to happen is you might have a good child, for example, who's doing very well at school and doing very well in their workforce and making good money. Your other child might have a drug or a gambling problem, or maybe they've been divorced a couple of times and not real good in relationships. So they've got no money. So if you appeal that under family provisions to the court, the judge will look at it and go, well, this child's got plenty of money. They don't need anything. I'll give all the money to the other child.
Which sounds very unfair. It sounds very unfair to the common person.
It does sound unfair, but that's what the judge will look at, because it's called family provisions, and the child with no money will argue they need to be provided more than the other child, which is sort of counterproductive, because the money may end up disappearing very quickly. But yeah, the child plan is a great facility, and we often get grandparents taking out 10 child plans and leaving money across the board for all their children, whether they're 5 years old or 15 years old.
When we do a financial planning advice, one of the key characteristics is, of course, to determine the risk tolerance of the investor, of the person who does the plan. You're conservative, balance, or you're aggressive, high growth, low growth, and all the stuff. And I think inside that instrument of the investment bond, we still have the choice to control how much risk we take from the investment point of view. Is that correct?
Yeah, that's correct. So we have investments that range from, we've got a beta geared share fund, for example. So if you go home tonight and read on the news that the share market went up 2%, the beta geared share fund will give you 4%. Yeah. Now, of course, if the market goes down 2%, you lose 4%. Or on the other end, you could invest in what we call the Pendle Enhanced Cash Fund, which pretty much sits with overnight deposits in the bank. And because interest rates are so low right now, that will give you maybe 0.25% return. However, your capital is very stable. And then on the way through, we have a balanced fund, which is 50% growth, 50% defensive, a growth fund, which is more 70-30, more growth investments, or you can go straight out into the Australian share funds and the international share funds. And some of those funds we've got in there with some of the managers such as T. Rowe Price and Bennelong, they've been outperforming the index by about 5% pretty consistently over a number of years. So you can get that extra return. What we tend to say to people, if you're investing for a longer term, it makes sense to have a little bit more risk. If you're investing for a shorter period of time, then you want to have less volatility in your portfolio. So as you know, you sit down with your clients, you understand their financial needs, and you can build a portfolio. The other thing you can do in an investment bond is you can switch without any capital gains. So if I've quite often in my life, I've bought some shares, the shares have gone up lots, and I'm sitting there thinking, I don't want to sell these because I have to pay a lot of tax. And I'm sure you have conversations like that with your clients. With an investment bond, I can be in, say, a more aggressive share fund for 5 years. If I make some good returns and double my money because we've had a great year like the last 12 months, then you can switch some of your money across to a more conservative investment. So you can do that switching online at no cost, and you don't have to pay any capital gains tax that you would pay if you were doing it yourself, because you're doing it within the One Life platform.
So really, in real terms, I put $100,000, say, went up 20% over a period of time, and 120, I feel a bit, concerned, and I get some advice, whatever. I can switch literally to cash for a period of time, with the risk, of course, to lose the uptrend if it comes. But whatever, I switch totally to cash, and then I can go back again to full investment, and still my performance is going to be capture the 20% what I've done, and then the new performance after the period that I was in cash. So it's really very flexible to switch on and off, and you don't have to consider capital gains.
Yeah, that's exactly right. And I guess in financial planning terms, we call that reweighting. You might start out saying, I'm going to put 50% shares and 50% in property, for example, and maybe the shares will have a big run, and all of a sudden you've got 75-25, and you think, well, I'll rebalance that. So you'll pull some out of your shares while it's high, reinvest it in property, and then maybe the next year the property will have a good run and shares will have a good run. So that's why I guess people see financial planners for their regular reviews, to do that reweighting. And the fund managers where we offer the diversified funds do that reweighting for you automatically, which is, as you said, it's just taking profits in the things that have gone up and banking them in something a bit more conservative.
Anything important, other information we need to know as on a broad area?
Yeah, I guess just a couple of things. On the investment options, I mentioned some of the active managers we have, and an active manager is a manager who tries to beat the index. So they'll have a team of research analysts burrowed away trying to figure out whether National Australia Bank is better than Commonwealth Bank or whatever it is in each sector. But we also have index funds. So we have Vanguard in each of our asset classes: Australian shares, international shares, small companies, property, and fixed interest. And with Vanguard, they're an index manager, like an ETF, and the index managers aim to just give you the index return. So you're not going to get that outperformance, but then at the same time, you won't risk the underperformance. And of course, the fees are lower. So an index fund, you might be typically paying 0.1 to 0.2%, whereas an active manager, you're probably paying up around 1%, because they've got to pay for all their research analysts to try to get you that outperformance. So that's something worth noting. A lot of people are fee conscious nowadays, and you can go into that low cost option. The other thing is we also have a couple of ESG options. So this is your environmental sustainability type of investments. And we've got one of them in Australian shares. We've got one of them in diversified in the balanced sector, and we've got one of them in the international shares. So you can, if you're concerned about the environment and the economy and the way things are travelling around global warming, those types of things, if you're against gambling and tobacco stocks and alcohol, as some people are, then you can invest in these ESG type stocks, where we'll invest the money to promote companies that are more sustainable and more concerned about the global environment. And that's becoming a big issue nowadays. I think if you're picking up the financial papers and reading about it, people are really thinking about that, particularly if you're a grandparent thinking of your grandchildren, because we don't know what the world's going to look like in 20 years' time. So promoting that responsible investing is something you can do under our fund.
I remember years ago when we talking about ethical investment, mainly was tobacco and children's slavery, child slavery. So just that's the two issues that came up, say, 10, 15 years ago. But now it's so many other things about ethical investment, is the environment, and is a lot of other parameters, green energy, also investments and all this stuff. So it becomes more complicated. So giving choices inside that instrument is also a very good proposition for consideration for any potential investor.
Yeah, that's right. And the G in ESG stands for governance, and that's something that we're seeing more of nowadays. And that's more about having equal females on the board and equal females on the management team. It's all about respecting the traditional owners of the land, those types of issues as well. So, as you said, that whole ethical investing has expanded to take across many different aspects. And if you look at the long-term numbers, not surprisingly, the ESG type investments typically outperform over the longer term.
Yeah, you're right.
And if you think that makes sense, if you're doing the right thing by the community and you're doing the right thing by the environment,
they perform better.
you're going to be better off in the long term. So I've put some money in some of those funds myself.
Excellent. Thank you very much for your time and the information. To all of you, thank you for joining us to Behind the Wealth. Till next time, have a good day.